Have a look at this chart. Won't you love to own this stock? The only problem is this chart is not of a stock. It is of the Indian Rupee. The Indian Rupee has decreased in value from 8 rupees in 1975 to 90 rupees in 2025 against the US dollar. That's a depreciation of approximately 5% per annum over 50 years. India's economy is growing fast, but why is the Indian Rupee getting weaker? India's economy grew little over 8% in the last quarter, which was the fastest pace in the last 6 quarters. Inflation remains within RBI's 2 to 6% range, and the Indian IPOs raised over $22 billion in 2025. All this is positive. Even with these strong numbers, the Indian Rupee made a low of 91 rupees against the US dollar. That's a fall of just over 6% in 2025. In fact, the Indian Rupee has been the weakest currency in all of Asia. So why is this happening? This is MK. I've spent over 20 years in the financial markets, and on this channel, I explain complex economic ideas in a simple and educational way. Now, let me explain this to you in 3 easy reasons. The first reason is foreign investors. In 2025, foreign investors withdrew $17 billion from the Indian equity markets. One reason is market performance. The Indian equity markets have underperformed massively this year. The Indian equity markets went up just over 6% this year, whereas the US equity markets went up just over 12% this year. So when foreign investors sell their Indian holdings, they sell the INR to buy a foreign currency. So this creates downward pressure on the Indian Rupee. The second reason is trade. Recent US tariffs made Indian exports more expensive to other countries. The result being that less dollars came into India from exports. At the same time, India still needs dollars to pay for imports. This increased the trade gap by $16 billion. When more dollars go out than come in, this makes the rupee weaker. And the third reason is Reserve Bank of India. The RBI has not strongly stepped in to stop the rupee from falling. Sometimes a slightly weaker currency can help exports by making them cheaper for other countries. So even when an economy is doing well, a currency can become weaker because of money coming in or going out, trade with other countries, and central bank decisions. The GDP growth alone does not decide currency strength. Thank you for watching. If you found this useful, please like, share, and subscribe. I'll see you in the next one. Bye. Past returns do not guarantee future performance. Always do your own research and speak to a licensed professional before making investment decisions.